Hello, this is part 2 of chapter 16, focusing on short-term financial planning. One of the key financial planning concepts is the cash budget. For those of you who have completed principles of managerial accounting, you will have already developed a cash budget at least once. For those who may be taking it out of sequence and taking it at a future time, this will serve as an introduction, but for most, will serve as a reinforcement of those concepts. And so we see here that our cash budget is to help us understand the short-term needs and opportunities of the business. Also understand when we may need more cash to make our operations happen. So to do that, we need to identify our cash collections or cash outflows, and then also look at our inflows, and we hope that our inflows are greater than our outflows. So we see here as an example, this company sales by quarter, quarter 1 to 100 million, quarter 4 400 million, and so we see some ebb and flow between that. We see that our beginning accounts receivable 120 million. This would be the December 31st balance from the previous year. We see that collections, we collect our beginning receivables for the quarter plus half of our sales. Now, just to put that into perspective, the average quarter has 90 days or 91.25 days, but we usually go with 90. And so if we are collecting half of our sales, that means that we have a accounts receivable period for our customers of about 45 days. So that's something that we just to understand the relationship. We see that our accounts payable, 60% of sales. What this would essentially mean is that our cost of goods sold would be 60 cents for every dollar of sales. Wages, taxes, and other expenses, 20% of sales. This would be something that we would learn by doing common size financial statements from past periods to understand what those averages are. We also see here that there's interest in dividends, basically the cost of financing of $20 million per quarter. And we see that in quarter 2, we want to have an expansion of $100 million. We also see that the beginning cash balance is $20 million, but we always want to keep at least $10 million in our cash account, which means that if we fall below that, we need to borrow. So let's see how this would be created. We see here that our cash collections, we have the beginning receivables for the first quarter, the 120. We have sales of 200. So the cash collections would be 100 of that 200 plus the 120. So that's where the 220 comes from. And then the remainder of the sales, the 200, half of that would be the ending receivables. And we see that the ending receivables for the first quarter is the beginning receivables of the second quarter. And so we see the cash collections that even though we're selling 200 million in the first quarter, we're actually collecting cash of 220 million. In the second quarter, we're selling 300 million, but we're only collecting 250 million. And so we see that ebb and flow. And then we look at our cash disbursements. So our cash disbursements, we know that our payments of accounts is 60% of sales. So we look at our sales number, 200, 60% of that is 120. In the second quarter, sales is 300 million. So 60% of that 300 million is 180 million. We also see here our wages, our taxes, our other expenses. That was 20% of our sales. And so we go up to the top, that sales number, 200 million, 20% of that, 40 million. And so that's what we're looking at. Again, we would have to do the research to make sure that those percentages for the cash disbursements are valid. We don't want to just identify a percentage and say, oh, that's it. We want to make sure that it's validated through a research source. We also see here that capital expenditures, those expansionary costs, are only happening in the second quarter. And then we have our long-term financing expenses at interest and dividends of $20 million. And so we see here that in quarter one, our total cash collections, 220, our cash disbursements is 180. So we see that we're bringing in more cash than we're spending. That's a good thing. However, in quarter two, our cash collections is 250 million, but we find that we're actually spending 360 million. That's a lot of a difference. And so we see that ebb and flow. And so that's an important part of this. I want to make sure that you catch on to those trends. So we put our information here together. And so we see that we have our cash collections, our cash disbursements, and so we have the net cash. So in quarter one and in quarter three, we're fine. We're generating a lot more cash than we're spending. However, in quarter two and in quarter four, we have a lot more going out. And so that becomes problematic for us. And so we see here that for quarter one, we have a beginning balance of 20. We add 40 to it, which gives us the 60. We have this 10 million as a minimum that we have, which means that our accumulative surplus is 50, but that 50 is not what starts the next quarter, it's the 60. And so we see here, we have our 60, we have our negative 110, which gives us a ending balance of negative 50. So we're going to need to borrow money to make sure that we have our appropriate $10 million of minimum. And so that's where the added information comes from. And so that huge 110, that's because of that $100 million outlay. We'll see more of this in the homework problems, and we'll talk about this in the Zoom session so you can see how it flows. So when we are needing extra cash, we need to look at those sources of cash. And so one way we can do that is in short-term borrowings, or what we would call unsecured loans, which means there's no collateral connected to it. The most common is a line of credit. And so lines of credit are usually established well ahead of time. And so if you are the financial officer of a business, you want to make sure that you have lines of credit with a bank. And so it could be a couple $1 million that you can borrow against at any given time, and then you would have a certain schedule to pay it back. Then we also see we have what we call the committed loan. And so this is where there may be some type of commitment fee and a floating interest rate. I'm never a big fan of floating interest rates because usually they float upward, but sometimes they do float downward. We're seeing that right now. We do have uncommitted, which would basically be a credit card. And then we also have revolving credit, which allows for a longer time than maybe like 30 days to pay. We can actually use our receivables as collateral for financing. There are some industries that this is very common, and so if you end up working in one of those industries, that's something to consider. However, it always gives me heartburn. But what we see here is we set up the accounts receivable as a collateral, but that just shows how important it is to make sure that we collect. We can do the assigning receivables, or we can also do factoring receivables, which means that we essentially sell it to a collection agency for a percentage of the value. So maybe if we have $100 million in collections, we sell it to a collection agency for $60 million, and then they go after those. We can do inventory loans. That's another way of using our current assets as collateral. And so we see here there's a couple different ways that we can do that. A blanket inventory lien, which means that that lien is against our inventory, and so as we pay it, we must pay them back, or as we sell it, we must pay them back. We have the trust lease, or trust receipt, and so this is where the retailer holds the inventory, but it's not theirs. They don't own it, and so they're selling it for other people. Could be an example of like consignment, but auto dealers would be an example of this. And then field warehouse financing. And so this would be where you actually move inventory into a warehouse and it's supervised by a third party to make sure that it's not misused. So in looking at the short-term financial plan, we saw the minimum balance here. We see the amount that we may need to borrow. And so that's that next component. Once we identify the cumulative surplus or deficit, we see how much we actually need to borrow. And so we see here our short-term borrowings in Q2. We borrow $60 million to cover the difference. But in Q3, we actually pay a lot of that off. And so we're paying off the 52 because we have it to pay. And then we have the remainder that needs to be paid as well. So that's the end of chapter 16, part 2. Please have your questions ready for our Zoom sessions on Wednesday and Friday.